We're going to be taking a look at Trade Desk Q1 earnings, but we're also going to be looking at it in the lens of how this impacts Google and Facebook as well, considering they're all in that digital online advertising space. What is going on, investors? Hopefully you guys are doing well out there. Time to look at the Trade Desk, a stock I think we've only looked at maybe once prior here on the channel, ticker symbol TTD. Now, this company over the last year, down 10% year to date, like a lot of stocks, been absolutely hammered, down 51%. That's on the heels of being down 2.75% today. And then in the after hours, after reporting their Q1 numbers, I'm seeing down about 5 to 6.5% on this one. We'll come over and look at it from a technical perspective. I tell you what, there is a technical setup here. I don't know which way it's going to go, but my guess is we'll see resolution to this technical setup in the next couple of days or so on TTD. So if you're looking at this from the long term, you're looking at it from the short term, if you're looking at like I am, and that your core positions in online advertising is going to be surrounded like by a Google. And in the past, if you've been following the channel, incredibly bearish on Facebook. Since their Q1 report several months ago, I'm completely out of Facebook at the current time. And I think as we walk through the Trade Desk earnings, I don't necessarily think the stock price of Trade Desk is a reflection of these earnings. I think it's a reflection, one, of the whole market, but also the fact this company has an over $20 billion market capitalization. It was almost or more than twice as high as that just a couple of months ago. And so we're just simply seeing the air let out of the balloon on a lot of the stocks. Now, when it comes to Trade Desk, their revenue in the most recent quarter coming in at $315 million. That was 43% year over year growth. But if you've been following the earnings season, it doesn't matter what you're doing this quarter. Nobody cares about your revenue. Nobody cares about your revenue growth. Nobody cares if you beat or you raise. It just seems stocks continue to go down. That's quite frankly just where we are at in this earnings season. They did beat expectations by that revenue. But what we can do is kind of ignore kind of the market noise and the volatility we're certainly seeing in the markets, and probably the overvaluation that we saw several months ago, maybe peak valuation in a lot of stocks, including maybe even potential of Facebook and Google as well. But I do want to factor this in, the fact that Trade Desk in the most recent quarter grew 43%. That was exponentially more than Google and much more than Facebook. But they also gave us guidance for the upcoming quarter, expecting revenues to come in at $364 million. Consensus was close to 300, basically 364. It's interesting. There was a headline saying that they missed guidance. I tell you what, in a bull market, this is coming in line on your consensus. They're missing by about $1 million on their upcoming revenue. My guess is they'll come just slightly over where consensus was. They're giving themselves a little bit of headroom. But I noticed that the Trade Desk, yes, they kind of pulled in just fractionally, pulled in their Q2 earnings, but we actually saw with Alphabet and particularly Meta as well, they really pulled it in. So I think one thing, if you're a Trade Desk investor or a bull or somebody that is bullish this name, well, I think we're seeing different competitive environment for the Trade Desk, and they look like they're surviving it much better. Obviously, the competitive environment is really twofold. I think you have TikTok pulling a lot of money away that might have been incrementally going to Google, and certainly Facebook as well. We're seeing probably investors, or advertisers essentially pull their money off of Meta platforms, because we don't see that with the Trade Desk. We're actually seeing pretty strong demand based on the expectations that the company had from a revenue perspective. And then when we look at the earnings estimates going out, analysts are still projecting kind of like high 20s, even 30% revenue growth for the upcoming quarters. And the fact that the Trade Desk did not pull in the most recent quarter is showing me that the competitive environment, which involves TikTok, which I think is absolutely pulling money away from Meta. But the other thing that is really impacting Meta as well is those iOS changes. It just simply has not allowed Facebook to add the tracking capabilities and the targeted ads that were so successful for the platform really since its inception. We're seeing a little bit of that with Google, but they control the Android operating system, so they're not going to shoot themselves in the foot and really kill off their business with a big change to that model. Not only that, when you look at iOS and you look at Google, how they advertise on that, the vast majority of that is through search, which is kind of a targeted ad. So my thesis here is that the Trade Desk is actually surviving the online advertising environment, actually actually considerably well. So let's come over here to the financials and see if it adds up to a $20 billion company, because that's basically where this stock is trading at today. We see the most recent results. We had that revenue go from $219 last year up to $315 million. Okay, certainly from a dollar perspective, that's a heavy ask on that price to sales multiple, okay, because you could annualize this number out and give them credit for a huge fourth quarter, and you're still exponentially paying for these sales. Now, we come through all the cost. Our platform operations went up by a little bit. Our sales and marketing went up a little bit. But what ballooned over the last couple of quarters is we have technology and development balloon, but also general administrative went from 51 all the way to 125. Now, I understand a vast majority or a large percentage of these total operating expenses, which came in the most recent quarter at $332 million. $125 million of those happen to be stock-based compensation. But we see here, we were at $52 million worth of stock-based compensation last year, and that is completely accelerated all the way up to about $125 million. So you take our revenues of $315 and you minus off $332, you get an income from operation actually swung to a loss of $17 million. Last year, we were actually profitable at a 7.7. But even if we had a year-over-year quarter, we actually improved our income from operations, maybe up to $10 million, say. Maybe didn't have so much stock-based compensation related to maybe an acquisition or a tie-in. Well, obviously, our income from operations would go up, but still annualize out $10 million, $20 million on that operating side. And we're still talking about a company that is likely still very richly valued at this market capitalization of north of $20 billion, considering the price to sales multiple you can get at Google. And certainly today, the price to sales on a Meta or price to earnings of Meta obviously way lower. Now, they're not growing as fast as Trade Desk. Their guidance wasn't nearly as much in line, but we're still talking about an elevated valuation based on these earnings. Sure, if you look out a year, 2 years, 3 years, this company's valuation from a price to sales basis and probably an operating profit perspective and likely cash flows as well starts to make a little more sense. But boy, a lot has to go well over the next couple of years for this company to realize that type of thing. Now, from a balance sheet perspective, looks okay. Considering they're compensating their employees with the vast majority of their employees with stock-based compensation, well, it looks fine from a cash perspective. From a cash flow perspective, it actually paints a pretty good story. You pull down a net income number of about $14.6 million. Okay, that's a loss. Last year, you made $22 million on that net side. Well, you get to add back in big, gigantic stock-based compensation of $124 million. We see here accounts receivable, somewhat bullish sign. This actually gives you a window into the upcoming quarter. The fact they have accounts receivable, this is business that is being booked right now. Typically in the ad business, if you have a large account, you're going to be like net 30, even maybe net 60, maybe even net 90 if you have great terms on those ads. So you're going to allow them to accrue in the quarter. And so Trade Desk basically counts that as a receivable. You see year over year, it's gone up a considerable amount from 208 million up to about 260 million. It's showing you that they have business in the system that is going to be worked through and recognized as revenue once they receive this payment, or they do the services required to clear that into revenue. Bullish sign there, quite frankly. Now you get these net cash provided by the operating activities really went up. Okay, it doubled, went from 75 million to 146, but the vast majority of that, or a lot of that, has to do with the stock-based compensation. It went from 52 million all the way up to 124. That's really going to swing your net income into a positive number on those cash flows. We see here they're spending a lot of those cash flows to grow the business, purchase of investments up to 121 million in the quarter. Last year, just 90 million on a quarterly basis. Now, all that adds up to a stock that's pretty richly valued, one that's going to have to see a lot of things go right, not only with their business, but obviously the online advertising business, and that is tied to the economy as well. Obviously, as we know, the broader economy is the one thing I think that is pushing this market down. If you get any kind of meaningful slowdown or the dreaded R word, a recession, well, guess what? That's pretty bearish when it comes to online advertising. We'll see if that materializes. It's just something to keep in mind. Certainly, if you're investing investor in TTD or Google or certainly Facebook as well. Now, from a technical perspective, we have pulled into an area of support down here at about $41 per share, give or take maybe 5% on that one. But we are in this mega downtrend. And what I wanted to do is point out the downtrends on these stock chart over the past, a year or two with this stock and show you this is not uncommon for the stock to go kind of on these mega downtrends and then they tend to break out of it. Well, right now we're at the bottom of a range. So when you're in these downtrend of a bottom of a range, not necessarily the greatest time to buy, but if you think this is a bottom for the stock and you think for some reason this stock is going to trade at a even more premium multiple to the market leaders like a Google, like a Facebook, well, these areas could make a little bit of sense. You're at the bottom of a channel, you're hitting a level of support. Quite frankly, it would make a ton of sense for this stock to bounce up. To me, this is setting up more like a trade. I could see buying the stock down at this level, setting a stop loss. I repeat, setting a stop loss when you're buying a stock in a downward trend and you're playing for it to bounce. You can be wrong. I don't know what the percentage of the time is, but it's probably a relatively high percentage. So you'd want to set a really tight stop loss when you're in this big of a downtrend. I'd put a stop loss down here, maybe $1, $2 under the stock, but you're playing your upside back to the top of this channel, which really could be north of about $50. So maybe you've got $1 or $2 a downside to play an $8 or $9 upside on this one. That's how, quite frankly, I would play this one, because I described to you from a price to sales and certainly price to earnings and even price to cash flow, stocks still richly valued, even factoring in this revenue growth. Certainly this revenue growth could come to fruition, but I tell you what, if it doesn't, this stock is going to continue to be beaten down. That is just the market we're in. It's nothing really against the trade desk. The multiple on these types of stocks got a little out in front of where the market probably was, and we're seeing a little bit, even more than a little bit, of a correction. We'll see how that materializes in the coming weeks and months ahead, but hopefully today's video helps you out if you own TTD or you think about it. Certainly if you own Google and Facebook as well, something to think about, that the online ad industry is affecting different players differently, and that's certainly a change from what we've seen since the tailwinds really pushed all these stocks up. Now we're seeing headwinds affect them a little bit differently. Hopefully you guys enjoyed today's video. We'll be back again soon with more. Good luck with your investments.